Now let's look at the hedge fund strategies, right? And within the equity segment, we have the long short people, right? Long short people. This is the most common strategy, followed by the market neutral. And then we have the long buyers and only a very small number of players that specialize in short buyers. Now, suppose you want to invest in Goldman Sachs, and I would ask you why, okay, right? And to be a good investor, you have to do your homework. You have to be convinced looking at the numbers, the balance sheet, the income statement, the PE multiple ratio, the book value. You have to be convinced that this is a great investment, okay, right? And you buy the stock and the stock market crash, right? And the S&P 500 is down 20%, and your Goldman Sachs stock is down 15%. Right? It is good or bad? Well, it depends, right? Okay, it depends because if you're hedged, then you outperform by 5%, right? So the idea here is that the professional money managers, when they invest in the stock they pick, like Goldman Sachs, they hedge by shorting the S&P 500. Okay, right? So most people do not do this long short. What they do is they would just buy the Goldman Sachs stock outright because they've done the homework, they're very convinced it's a great stock. And then what happened is that the stock market crashed. The stock market crashed, and Goldman Sachs lost only 15%. Right? But losing 15% is less than the market losing 20%. Is really no consolation. Right? So this is the difference between the regular investor and the professional investors. Professional investors, they use this long short strategy. Right? So if they are long short, Goldman Sachs loses 15%. They've shorted the S&P 500, which is down 20%. So minus and minus become 20%, right? So they're up 5%. Okay? Suppose the market didn't crash, the market continued to go up. Goldman Sachs, say here in this example, returned 17%, and the stock market returned 10%. The long short strategy would be up 7%, right? So then you will say, well, how come, in this example, you are saying that if the stock market goes down, we make 5%, stock market goes up, we make 7%. Well, that's because, right, I asked in the very beginning, why did you pick Goldman Sachs, right? So if you have already done your homework, right, you feel that this stock, right, justify the belief that you think it will outperform the market, right? Okay, then it will outperform the market through bad times and good times, right? So the key here is in this long short strategy, right? You long what you know, and you short what you do not know, right? You long Goldman Sachs because you've done your homework. You know, you're confident that you have done your homework well, and you short what you don't know because you do not know how the S&P 500 would behave, right? So you short away, right? You go short what you do not know to hedge away that risk, and you you have the ownership of something that you are confident with, right? And here I just want to expand this a little bit more. In this example here, we see the GM stock going up, right? And Tesla has done very, very well, and Ford pretty much stable, right? So a hedge fund may want to go long GM and short SPY, okay? Right? Long GM and short SPY because they believe that the GM would continue to do well because GM is now focusing on the driverless cars. Or they may want to go long GM and short Tesla, right? Okay, and they may also want to go long GM and short Ford. Okay? So although we see this long short in three different ways, the true expression of hedge strategy is long GM, short SPY. Okay? This is the the right approach to hedging your risk. Long what you know, short what you don't know. In this case here, long GM, short Tesla, this is taking two significant bets. Two significant bets. This is not hedging. This is not hedging because the hedge fund can lose money on both trades. Okay? Similarly, long GM, short Ford is also taking two significant bets. So the objective here for a pure long short strategy is not to be market neutral. Right? You have to have some risk, and you have a stock pick, hedge against the overall, or you hedge against the sector. Right? So, for example, we talk about going long Goldman Sachs and we short SPY. Well, we can also long Goldman Sachs and short the financial sector. Okay? Valuation, right? So some strategy would involve going long the undervalued one and short the overvalued one. Okay? Right? And the third strategy would be the long winners and short losers. Right? Uh, a common example would be to go long Amazon and short Toys R Us, okay? Or short JCPenney, right? Or short Nordstrom, and so on. Right? And instead of fundamental approach, some hedge funds would use their own black box. They have their quantitative approach. The basic idea is long something and hedge against the market. Then we have the second strategy, and this is the equity market neutral, where we have a long and short in matched equity portfolio of similar size within a country. So it sounds like a mouthful, but the important thing is that this is designed to be either data or currency neutral. So we are taking two companies of similar size, similar strategy, long one, short one, okay, right? And take very small amount of risk. This requires a lot of statistical arbitrage, and obviously when you're long one and you short one, for very small difference, you need to leverage up and you need very deep liquidity. Here is a very simple example. I'm showing you the scatter plot of Citigroup and Bank of America. Because to many people, these two banks, they perform similar function, right? And unless there's major changes in management or strategy, their stock price should trade in a similar up and similar down movement. Right? So whenever there is a blip, like this particular point here, right, the equity neutral people would come in, right, and take advantage of this blip and hope that it would realign back to the regression line. When we look at the capital market, we had talked briefly during the fixed income session that when we see these four different markets, we keep asking what is a dominant risk. For the treasury market, the dominant risk is interest rate risk. For the triple A, right, and the triple B, there is the credit risk that we have to be careful of. Like credit risk is more important for corporate bond than for treasury bond. Okay? And for the mortgage-backed securities, we are concerned with the prepayment risk. Right? So here, the hedge fund people, they look at relative value. They look at relative value, and they look at this fixed income arbitrage, and they try to take advantage of the bond pricing disparity due to the investor's preference or changing market event. Right? So when they see that the the triple A and the treasury often trade within a certain range bound spread, when they see that the investor preference have changed and they don't think that this change is significant, then any kind of blip the hedge fund will come in and take advantage of these blips. And they try to avoid directional risk, meaning that they try not to bet on whether interest rate will move up or down. Right? They are just basically looking for the spread, right? Hoping that the spread will somehow return back to normal whenever it gets out of the normal range. And because they are making a very small amount of profit for each of these trades, they need to leverage it up. And it could be leveraged 10 to, in the past, we have heard as high as 150 times. But those days are over. Now the leverage is a lot less, but still quite significant. The fourth strategy is the convertible bond arbitrage. And this is where the hedge fund will go long the convertible bond and short the underlying company stock. Right? So when they do this, right, then they are hedged. Right? Why? Because if the convertible bond were to lose money, there will be a time when the stock market, the underlying stock price would have come down as well. So if the hedge fund is losing money on the convertible bond, this is offset from the profit they make by shorting the company common stock. Right? So they are hedged away. Right? So why would they do that? Well, when they do something like this, long convertible bond and short the underlying stock, they get to keep the coupon. Right? They get to keep the coupon. And the coupon that they collect, right, when you add up every year, right, 6-7% a year, after 10, 20 years, that's a lot of money, right? And simply because they have hedged away the risk. Okay, all right. They also have the benefit that when the market is very volatile, the embedded option in the convertible bond is now worth a lot more money, right? Because the embedded stock option would be priced according to the implied volatility. So when the market is very volatile, the implied vol would go up and make the call option more valuable. The fifth strategy is merger risk arbitrage. Right? In this very simple example here, suppose company A want to buy over company B and announce a buyout price at $20. The market for company B shares will trade immediately up and close to $20, but not fully $20. Why? Because investors will say that there is a small chance that the merger would not go through, right? So they won't price it to perfection. So there's a small gap. So in our example here, the current trading price would be traded up to $18, like below the $20. So there's an arbitrage spread of $2, right? So the hedge fund people that specialize in this, they would have employed former regulators. They would have employed former investment bankers who understand the industry very well and who can then say, you know what, we think this merger will go through. There will be no obstacles from the regulatory side. And this merger makes sense from the perspective of synergy and so on, right? So once they decided on this, then they would buy the stock price of B at $18 and just wait for the merger to close at $20. They get out, right? So typically they will go long the company stock of the company that's being acquired, and sometimes they would also go short the acquiring company. Obviously, the risk here is that the arbitrage failed, okay, right, and the deal could not go through, right? And when the deal doesn't go through, then it can be very painful. Like for example, here, Pfizer walked away from the deal. When Pfizer walked away from the deal, Elegant share price fell by almost 15% immediately. Right? But if you look at the mathematics of this, and you look at the number of the amount of shares of a merger that was announced, and you look at those that were broken, right, you will see that the amount of money involved in those that are broken is a lot less than the total amount that was announced, right? So this tells you mathematically it does favor a strategy like this because more often than not, the merger goes through. Number six is distressed securities, right? And this is where the hedge fund will invest in debt or equity or trade claims of a company that is in financial distress. Okay? Obviously, when they invest in this kind of company, they would ask for a very high uh, interest rate. Okay? And obviously, many of these investors know that there are other investors that cannot hold the securities of these companies that are in trouble. Right? So there's very little competition for this hedge fund that specialize in distressed securities. And where necessary, these hedge fund people will become active managers and they get into the creditor committee and they will help and they will push their way to how the asset, right, should be liquidated or how the company should be reorganized. So the skill set here would include people with legal background and people that are good in turnaround, restructuring activities, and people who know how to value asset and understand the economic trend. Why? Because if the economy is going to recover from a recession, then the chance of this company that is in trouble would be able to either sell the asset at a higher price or be able to pivot, right, to a business strategy that can help them when economy recovers. A very good example of this kind of distress securities would be Toys R Us. Right? So this particular Toys R Us senior unsecured bond that was trading around par, around 100, suddenly collapsed because Toys R Us announced that they are going bankrupt. The distressed security people who understand the asset that Toys R Us own, and they understand that they can strip out the logo and sell that logo to Asia, and they understand the properties that Toys R Us own, where they're located, and they have a rough idea of the valuation of this real estate. So they are the people who come in and say, you know what, even though this bond is senior unsecured, right, at this kind of valuation at $18, right, after the after these secured investors are paid off, there will be still some money left for people like us if we were to buy this particular bond. Number seven is the Reg D fund. Right? Reg D is a special regulation that allows the hedge fund to invest in micro and small capitalization public companies. Because for these small companies, for them to go on a roadshow to sell another bunch of shares or to issue a corporate bond, it's just too expensive for the small amount of money that they want to raise. So they would approach the hedge fund people that specialize in this, and they would be willing to pay a higher rate, right, in order to get the money, right, instead of going through the larger investment banks. And in return, right, these hedge fund people, they would often ask for convertible bond or a convertible preferred issue, right, in return for the capital that they provide. Why convertible bond? Well, because A, as a bond, they are able to have the first claim of the underlying asset, and they would also get paid interest before the earnings is distributed to the shareholders, right? And if the company were to recover nicely, then this hedge fund can convert their bond into equity. So, and unlike a standard convertible bond, the exercise price can float or subject to a look back, right? Meaning that the company, the hedge fund can say that, well, under particular circumstances, we have the right to go back and adjust the interest rate that we want you to pay us, right? So, for example, if management were to change in the company, right, then we have the right to go back to time and adjust the interest rate by another 2% or 3%. Then number 8 is high yield investing, right? And this is where the hedge fund, they look for a credit upgrade, or they look for potential takeover targets or redemption of outstanding high coupon issues. So as we have seen in the fixed income module, this is where the hedge fund would look at, for example, the BBB, and know that historically 3.7% of the BBB get upgraded. So they would have their analysts combing through all the triple B bonds and go through the accounting data and the trend in revenue and trend in earnings and the capital structure, and then try to figure out which of these has a good chance of being upgraded, right? So they employ a lot of people who are very good at company analysis and very good with accounting data. Obviously, what's important to them is also uh, the, the area where there's greater stability. If there's greater stability, like for example, here we have the double A, 86.6% remain unchanged from the beginning of the year to end of the year, then there's not much opportunities in looking for an upgrade. Right? In contrast to the double B, right, 85.2% get upgraded, and the CCC area, right, only 43% of these bonds remain unchanged. As high as 13% get upgraded to single B, and 0.83% get upgraded to double B. So there's a lot of incentive to dig for companies that has a good chance of being upgraded. Number 9 is corporate restructuring, right? Often they start off as friendly and then they become hostile activists. So essentially, these companies are looking for, they invest in company that has a lot of cash, okay, right? Why? Because they would want to persuade, as in this good example here, this hedge fund, right, was pushing for a massive Apple share buyback, okay, right? So here you see, like when they announce that they are pushing for this 60 billion, $50 billion buyback, right? Obviously, they can only push a company that has a high amount of cash sitting there, right? Okay, there's no point in pushing a company that will say, okay, fine, I listen to you. It takes me time to go and sell a bond, raise the money, and then come back and buy back shares. Right? So, in this particular case, right, the hedge fund made good money, and they argue that Apple payout ratio has been extremely low compared to Microsoft, Intel, and Cisco. Okay? So this justify why they think that Apple should pay out a high dividend and buy back shares. Okay? Essentially, transferring some of the cash that Apple has to the shareholder. Well, here is another example where you have this hedge fund, Starboard, fighting with the Darden people, right? And the fight went on for quite some time until October 10, when the Darden shareholders, right, a majority of these shares are now controlled by the hedge fund and their friends. Right? So the shareholders voted to replace all 12 directors of the Darden board. When that happened, Darden shares pop up immediately. Okay? Okay. So what's the lesson here? Right? Well, the lesson here is that if you are a board member and hedge fund come to you and say nicely to you, please pay a high dividend or buy back shares because as shareholder, we want you to transfer more cash to us, right? Well, if you go along with them, like Apple, right, you get to keep the job, okay, right? Okay. If like the Darden board, you want to fight them, right? You want to fight them, then what happened is that they are going to gather enough votes to kick you out from the board. Okay? Right? So that's why I say that the activists, they often started off as very friendly, giving very good advice, and say, just buy back your shares, just pay us high dividend. And then it turned ugly when the board disagreed. Number 10 is dedicated short buyers, right? This is where the hedge fund people, they would need very efficient stock borrowing and lending facilities. They will do their homework and they will find a company that either uh, has a fraud in accounting or the business plan is very bad. They would then go short this company. They will get their brokers to borrow shares in the market, and then they will go short the stocks, or they will buy a put option. And after that, they go on television and then they talk about why they think that this company is going to go down. Right? I would recommend that you go to this website, Muddy Waters Research, and they will tell you a lot about their experience of how they discover opportunities to go short. Right? And when you look at the track record, you will find that more often than not, whenever they pick a target, they have been more successful and the share price have come down. And when the share price come down, they have shorted the stock, they buy back at a cheaper level, and they close out the trade, then they move on to another target where they go short again. The other strategy is the global macro people, and they can be discretionary. For example, Soros. Like Soros here was fighting against the Bank of England, expecting the pound sterling to drop sharply. And what happened was that the Bank of England was intervening in the market, and the Bank of England keep buying the pound sterling, right? And as they keep buying the pound sterling, they have to sell US dollar, and they keep doing that, and they try to push the pound sterling higher and higher, right? Hoping that George Soros would give up, right? Because George Soros was selling the pound sterling, and the Bank of England was intervening to push the pound sterling up, right? Causing Soros to lose money. But Soros became even more aggressive and keep selling the pound sterling. And what happened was, in the end, the Bank of England, as they intervene to buy the pound, they sell dollars. And at that particular point in time, the dollar reserve came down sharply, and the Bank of England just gave up, and the pound sterling dropped rapidly the next few days. And George Soros made a name for himself, making $1 billion that few days. Some of these global macro people, they would use a trend following model. And here's a very simple example. A simple example where if you use the 17-month moving average, you can see that it provides a very good indication of support. Right? Every time it gets near to the moving average, it gets supported and bounce back. The time when it breaks the support, that's when the hedge fund people that follow a model like this will go short because they believe that the trend has changed. Right? So from an upward trend to a downward trend, right? And then they would buy back when the downtrend turned back into an uptrend, right? So, there are different models like this, and I would encourage you to explore and learn about this kind of trend following model. Finally, the number 12 strategy are the black box or the rocket scientists or the quantitative people. Okay? So as the name implies, they develop the model either using neural network or machine learning or data mining, and they would not disclose to you exactly how the model works, and they would show you the backtesting. Right? And the verdict right now is not clear because a lot of these black boxes looks great on backtesting, but when it's implemented in the real world, somehow these models could not fully capture the new development in the market. So this concludes the strategies for hedge fund.